The Great Depression was not just a US crisis. It caused economic damage and human hardship on a global scale. In this video, I'm going to look at 6 similarities and 3 differences between the state of the world then and now. And that should help you make up your own mind about whether we're entering another Great Depression or just a globally synchronized recession. Now, in order to help you navigate your investments through a crisis such as this one, I've created a course with lots of exclusive content, and there'll be a link to that above me and in the description below. So now let's look at the Great Depression in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. One of the big similarities between the Great Depression and the current situation was the equity market rally that preceded it, which lasted about a decade. Here's that rally in the 1920s, and you can see that if you'd invested $1 at the beginning of 1921, that would have turned into just under $8 by the end of the rally. In fact, it wasn't exactly a decade, it was just under 9 years. But on average, you'd have gained almost 27% per year over that period, which is a fairly spectacular average rate of return. The long-term average for the S&P is much closer to around 6% per year. Similarly, if you'd have invested just after the global financial crisis, every dollar invested would have turned into just over $4 just before the sell-off in 2020. And this rally was a little longer than the one just before the Great Depression, at almost 11 years. But the rate of return over that period, although it was extremely high, wasn't as high as it was during the Roaring '20s. If we overlay those two total return plots, such that their peaks line up, you can see that this rally hasn't grown as quickly as the one in the 1920s, which is in green. But after that big crash in October 1929, you can see that there was a very strong bear market rally, which lasted 5 months and in which the market gained 28%. Recently, markets have also had a big rally of 40%, and so far we're about 3 months into the rally. Another similarity is wider stock ownership. After the First World War, the US government was trying to get people to buy their Liberty bonds, which was a way of getting money into the US Treasury. And they used famous film stars like Charlie Chaplin in films such as The Bond, which is available on YouTube if you're interested. And this made it much more socially acceptable for people to invest in bonds, but also in equities. So in places such as the Waldorf Astoria Hotel, there were ticker tape machines and boards displaying stock prices. And if you really made it, like this portrait of Thomas W. Lawson, you could even have a ticker tape machine in your own office. And this let you keep track of stock prices which were printed out on a piece of paper. Of course, nowadays we've got a much more convenient way of keeping track of stock prices, but also of trading. Robinhood entered the US market about 6 years ago, and its unique selling proposition was that it allowed you to trade commission-free. And now many other US brokers have gone down the same route, such as TD Ameritrade, which cut its commissions to 0 in 2019, and as a result it saw a rapid rise in the number of daily trades from its clients. During lockdown, there's also been a very rapid rise in the number of people opening brokerage accounts. The new accounts for these 3 very large brokers were twice as large as they were at the same time last year, with spectacular year-over-year increases in the number of accounts. And the sports blogger Dave Portnoy has branched out into talking about stocks, and he claims that he's now the captain of investing, and that Warren Buffett, although he's a great guy, is now washed up. And in the same way, in the 1920s, there were many people getting into the market because it was seen as a sure bet after that incredible decade-long rally. Now, there are many seasoned investors who are saying that this rally has gone too far, too fast. And in the same way, Paul Warburg made similar warnings in the 1920s, saying that unrestrained speculation would lead to an ultimate collapse, and this could bring about a general depression involving the entire country. Now, even before this crisis, the global economy was weakening, just as it was at the end of the 1920s. This was from the World Economic Outlook in October 2019. They pointed out that global growth was in a synchronized slowdown, and the reasons they gave were rising trade barriers, with the associated uncertainty in trade and geopolitics, but also there was strain in several emerging market economies. And there are also long-term factors at play in advanced economies, such as low productivity growth and an aging population. And as a result, they downgraded their growth forecasts. And whereas we'd seen synchronized global growth in 2017, this had turned into this slowdown that you can see here. And whether we looked at industrial production or world trade volumes or purchasing managers' indices, all of them were on a downward trajectory throughout 2018 and in 2019. Although people tend to focus on Black Thursday, which was a big sell-off in October 1929, Ben Bernanke pointed out that if you didn't buy at the peak, but instead bought in January 1929, which is just before the peak, then thanks to this very large bear market rally, you would have roughly broken even if you'd have sold your stocks in October 1930. And in fact, stock prices didn't collapse in 1929, but really began to fall very sharply due to an onslaught of bad economic news. You can see that there were 4 successive years where economic growth was negative, starting in 1930 and ending in 1933. And it wasn't until the fall of 1930 that stock prices finally fell below their 1928 levels. And if we look at almost any of these economic indicators, you can see they're trending downwards, whether it's industrial production, factory employment, freight car loadings, or department store sales. So if we do see the economic data continue to deteriorate and not to recover to previous levels, then this eventually could have a negative impact on equity prices. But it could take a long time, and it could take a very large deluge of negative economic news to convince people that we're in bad straits. Another similarity is that we're in an earnings recession. This is the growth in real earnings year on year between 1920 and 1935. I've marked the stock market crash with a red line. And you can see that for most of that decade when we had the very strong equity rally, we had very large positive earnings growth. Only after the crash did we start to see that fall in year-on-year earnings. If we go back to the global financial crisis, you can see that we also had a very large fall in earnings, which reached a minus 90% fall in March of 2009. But subsequently, we had this huge rally as earnings went back to their previous trend. So this was even more marked than what we saw in 1929 in terms of earnings growth. The red line here marks the date when Tom Hanks announced that he had coronavirus. But you can see that US earnings growth had already turned negative before that happened in March 2020. And if we look at the quarterly earnings seasons, the ones in blue are the ones we've already seen, and the ones in red are forecast. Notice how in 2019, earnings growth had effectively stopped for the S&P 500, and that was before any effects of this pandemic. And for Q1 2020, we've had a minus 14% fall in earnings, and the forecast is that that'll more than double to a fall of almost 30%. But the expectations are that we're going to have a huge bounce back in Q3 2020, and then we'll fall back to low levels of growth which we saw before. So it's clear that many people are pinning their hopes on lots of pent-up demand and a very large and rapid bounce back in corporate earnings. If that fails to materialize, or the lack of demand extends longer than we expect, it would be reasonable to expect that that would have a negative effect on the equity market. Another similarity is protectionism. We've just passed the 90th anniversary of the Smoot-Hawley Tariff Act, and this imposed tariffs on 20,000 imported goods, and it was supposed to support US industry by making imports more expensive. Many economists at the time warned that it was a mistake, and it provoked immediate retaliation from many of the US's trade partners, such as Canada, which then went on to form trading blocs which excluded the US. And the general consensus in retrospect was that the Smoot-Hawley Tariff Act made the Great Depression worse. But a cornerstone of President Trump's policy is that a trade deficit is a losing proposition, and just looking at the US-China trade tariffs, you can see that they've generally been ramping up since 2018, and many of them remain in place, despite the Phase 1 trade deal. And of course, the people who pay these tariffs are US companies and US consumers. And as Paul Krugman pointed out, The effect of the trade war hasn't been to reduce imports. It's simply shifted the imports away from China to higher cost sources. And the example he gives here is imports from Vietnam. And just as in the Great Depression, the consensus from economists is that the trade war is hurting the US economy, as it's hurting economies elsewhere, such as China. The last similarity that we'll note is unemployment. Now, the level of employment that we've got at the moment in the US is similar to what it was during the Great Depression. However, there is one huge difference. Notice how the unemployment rate in the 1930s ramped up quite slowly over the space of about 3 years. Whereas this time round, we've gone from unemployment, which was at a 65-year low, to depression-level unemployment in the space of 1 month. The Bureau of Labour Statistics pointed out that many people misclassified themselves, and the actual rate of unemployment should have been over 20%, which would be very much in line with what we saw during the Great Depression. But a more worrying statistic is that if we had full recall of all the people who were temporarily laid off, that would still take the US unemployment rate to depression levels of 7.1%. And it's not just the US which has seen a massive rise in unemployment. The Bank of England's Agent's Summary of Business Conditions shows that many companies anticipate having to lay off workers if they don't see demand recover once the coronavirus job retention scheme is phased out. Another problem is that social distancing measures would limit output, which means that you can't employ as many workers. Also, during the lockdown, some employers have been able to improve productivity without the need for so many staff. And as a consequence, recruiters say that vacancies advertised have fallen sharply. And all of this points to scarring in the labour market. In other words, once the lockdowns end, we won't go back to such high employment as we saw before the lockdown. And this is very much a global phenomenon, with a rise in unemployment all across the world. And the OECD forecasts that this could last for some time and would be exacerbated if we had a second wave of infections. But it's worth noting that some countries have been spared such a huge blow for unemployment, and that would include Canada, Germany, and Japan. Now let's get to the differences between the 1930s and the current situation, and we'll start with bank failures. The bank failure rate in the 1930s was incredibly high, reaching almost 6% per year. The Federal Reserve calls bank failures banking suspensions, and this is the number of banking suspensions per year from 1920 to 1936. After the stock market crash in 1929, this spike in the number of bank failures probably made the Great Depression much worse, and the bank failures didn't peak until 1933, when 4,000 banks failed. At the time, not all banks were covered by the Federal Reserve System. And remember, the Federal Reserve acts as a lender of last resort. And part of the reason why it was created was to stop runs on banks. What happens during a panic is that everybody wants to pull out their money at the same time. And generally, banks don't have enough reserves to pay everybody off at once. So there was a system outside the Federal Reserve System called correspondent banks, where if there was a run on one bank, they would ask their correspondent banks for reserves so that they could pay back their client deposits. But the problem during the Great Depression was that there could also be a run on the correspondent banks, which meant that the correspondent banks couldn't help. And in some cases, the correspondent banks didn't want to help because they had to preserve their reserves for their own survival. And this led to what was called a correspondent cascade, as bank after bank failed as people pulled out their money. However, this didn't happen to the banks that were protected by the Federal Reserve System. But of course, nowadays, all banks come under the Federal Reserve System. And thanks to the crisis in 2009, the Tier 1 equity ratio, which measures the safety net that banks have in the form of loss-absorbing equity on their balance sheets, is much higher. So it's much less likely that we're going to get a banking crisis this time around. In order to preserve their balance sheets, banks have been tightening their credit standards in their commercial and industrial loans. So in Q1 2020, the credit quality of borrowers had to be much higher to be eligible for a loan. which is probably wise because the leverage of those companies which were going for the loans had deteriorated. The debt as a percentage of assets has been rising steadily since 2013, so banks have to be more picky about the entities to whom they lend. And for these reasons, we certainly haven't seen a big pickup in the number of bank failures, or at least not yet. Another big difference between the 1930s and the current day is leverage. Let's say that you buy one stock of Apple at the beginning of January 2020. You'd have bought it for $300 and the price went up a little bit, then it went down in the crash, and now in June 2020, your stock would be worth more than it was when you bought it. But in the 1930s, you only had to pay 10% down and borrow the remaining 90% from your bank in order to buy that stock. Now, if the stock goes up, that amplifies your profit. But if the stocks went down, because you only paid about $30 up front, you'd have actually lost more than your entire investment. And at this point, your bank would have asked for margin. So when equity markets sold off in 1929, they demanded margin calls from many of their customers who simply didn't have enough money to pay them back. And this was part of the reason why there were so many bank failures. In fact, if we look at 1930 and where banks had made their loans, about half of the loans they'd made were for people to buy securities, such as equity and bonds. Nowadays, the provider of the loan is your broker, and brokers are much more careful about not lending too much money to their clients in case things go wrong. Another huge difference is the policy response that we've seen in response to the crisis. There wasn't a Fed policy rate at the time, but we can see the discount rate for the Federal Reserve Bank of New York between 1920 and 1940. And what's clear is that even during the recession, it took a very long time for rates to come down. Whereas in this crisis, the Federal Reserve cut rates to zero almost immediately. And if we look at the response of governments, in other words, the fiscal policy response, it's clear that if we compare this crisis with 2009, for example, the size and the speed of the response has been much bigger than it was in 2009. In fact, if we look at government debt, the consequence of the very large and rapid response has been that governments have plugged the difference between expenditure and income using government debt, which has ballooned in 2020. And if we look at the fiscal balance, which is the income of a government minus its expenditure, that's created a massive deficit in 2020. And although we've seen a slew of measures already, and this is just the measures we've seen for the UK and for the US, the consequence may be that we have a huge amount of debt that becomes very difficult to pay back, unless we can restore growth to pre-crisis levels. And the same's true of monetary policy. These are the credit facilities which the Federal Reserve has made available, and that's expanded the Federal Reserve's balance sheet to over $7 trillion. And although the Fed says this is a temporary measure and that they'll put the tools back in the toolbox after the crisis is over, it's going to be very difficult to unwind the Fed's balance sheet. So apart from the obvious difference that this crisis was triggered by a global epidemic, there are some surprising similarities between 1929 and the state of the world now. So if you enjoyed that video, please do support us. It costs just $10 on Patreon. You get access to this chat application called Slack, so you can ask questions from me or any other members of the community. Plus you get access to live Q&A calls, which are only available to Patreon supporters. And there's a growing library of video content, which is only available to members. So I hope you do support us and I get to see you on one of those Q&A calls, or I get to chat with you on Slack really soon. And as always, thank you for listening.